Hello everyone. Today we are going to have discussion on a recent judgment of Mumbai Tribunal in the case of Abu Dhabi Commercial Bank. In this case, SAC is a non-resident banking company having its head office in UAE and was a tax resident of UAE. The SAC was involved in normal banking activities. In the course of its business activity, SAC had advanced external commercial borrowings to Indian customers directly without involvement of its branches in India, which are nothing but PE of this company in India. SSC had earned interest income on this ECB and offered it to tax under Article 11.2 of India UAE Tax Treaty at the rate of 5% on gross basis. During the year under dispute, the SSC's P in India had suffered losses under the head business and profession. So while computing income, total income, the SSC had set off business losses of P against interest income, and on the balance interest income, the SSC computed tax at the rate of 5% as per Article 11.2 of India UAE Tax Treaty. During assessment proceedings, the assessing officer has disallowed this set off of losses on the ground that interest income was taxable on gross basis as per tax treaty, so no further deduction including set off of losses are allowed. The matter travelled before Mumbai Tribunal. The ITAT held that A, that there is no dispute in terms of offering this income under the head income from other sources. Both SSC and assessing officer has accepted this. Now, on the second part, with regard to set off of losses, the court held that SSC is covered under Article 11.2 of the treaty, 11.2a of the treaty. On reading of Article 11.2a, one will find two parts. The first part talks about the interest income can be taxed in the source country in terms of domestic laws of source country. The second part of the article says that if the recipient of interest income is beneficial owner of such income, then tax rate will be at the rate of 5% or 12.5% as the case may be. So it is clear from the reading of Article 11.2a that in the first step, the taxability of interest income has to be determined in terms of domestic laws of source country, and post that one has to refer to tax treaty for tax rate purposes. So the court held that SSC can adopt hybrid approach and can claim set off of losses. Means the SSC should compute the taxable income by referring domestic laws of India, and once the income is determined, it has to refer to tax treaty for tax rate purpose. So ITAT has allowed set off of business loss of PE against interest income by the taxpayer. On the question of gross basis taxation, the ITAT held that for income from other sources, the deduction which is allowed is under section 57, and in this case, the SSC has not claimed any deduction under section 57. So the income computed by the SSC does not violate the conditions of section 11.2a of the treaty. And according to the relevant provisions in the first stage, the computation of total income of the SSC has to be in terms of the provisions of the Act, which is domestic law, and after set off of losses under section 71. That's what the computation of income is. And once the income is computed, the applicable rate of tax has to be as per Article 11.2a. So SSC was right in terms of setting off the losses of PE against interest income. This is what the Mumbai Tribunal has upheld in a recent judgment in the case of Abu Dhabi Commercial Bank. You find many such income like dividend income, fees for technical services, etc., are being taxed on gross basis in the hands of non-resident taxpayer in India. So one needs to really see that the implication of this judgment on other type of income which are taxable on gross basis, whether one can extend the similar logic to other kind of income, again dividend and fees for technical services. B, we need to wait and watch if this matter travel further before High Court, how the High Court is going to view this. So just wanted to share this judgment with you. Keep analyzing and keep reading. Thank you.